I'm Peter White. Welcome to the Inside Network. Welcome to InDepth. I'm Peter White. My guests today are Luke Smith and James Stewart from Ausbil Investment Management, the two portfolio managers for their Global Resources Fund. Welcome, gentlemen.
Thank you.
Let's start by performance. You've had a great 2020. How have you done it in these difficult conditions?
Yeah, it sort of gives us a good opportunity to explain the fund, I guess, as a starting point. So, we work at Ausbil, run a global resources fund with an absolute return approach, which means that we've got a long-short strategy that with the aim of generating returns through the cycle. Ultimately trying to ensure that we protect capital at the lows of the cycle and capture the upside that are offered within resources more broadly. So, within all that, as a backdrop, risk management is key for us, and focus around risk management is key. So, back in the first quarter, obviously, a lot of volatility, more broadly, but the protection that we had on our portfolio, our ability to short stocks as well, take the fund net short more broadly.
Tell me about the protection.
So we run a layer of out of the money put options across the portfolio on resources stocks more broadly. So that's the starting point, and we see that as good insurance for the fund more broadly, and that really was called out in March in particular, where through periods of March we were actually up when the market was getting hit quite aggressively. So that as a start is really gives us a good example as to how as a start we made money. On top of that, we got a good look at COVID earlier in the year, and we're very focused on China as a start. So obviously COVID hit China earliest. Jimmy and myself did a lot of work and understanding as to how that was impacting their economy, how that was impacting their ability to sort of grow the economy more broadly. And we took a view that the rest of the global economy was significant and really positioned for that through the first quarter. And then I guess secondly, in the rebound since late March, we've captured the majority, if not all, of the upside that have been on offer from resources more broadly. We've been running low net exposure for the fund, so we haven't been taking big risk in the fund more broadly, but we've still been generating significant returns and outperforming resources benchmarks more broadly. And I guess the key areas where we've generated those returns in the rebound, firstly, we had a non-consensus call on iron ore. We did a lot of work on iron ore over the last 18 months. But as a start, it was a key area that we positioned the fund for the positive dynamic that's played out in iron ore. We've unwound that position more lately, but really we got ahead of the curve there, and that's been one of the positive drivers. Through the recovery, gold, copper, sort of had some strong positioning, and that's generated some strong returns for us as well. And then more recently, pivot towards battery materials. It's a space that's been under a lot of pressure for the last couple of years since its highs, sort of in 2017, 2018, and we pivoted the portfolio there as well, and it's sort of generated some strong returns for the fund as well.
Did you foresee China recovering so quickly from COVID? Did you pick that or not?
Oh, look, we thought they'd recover. But
do you believe it, I guess?
Oh, yeah, definitely we believe it. The data all confirms that. But it's probably been, a real surprise at how quickly they've turned back on their economy. And some of that is the fact that they were, stimulating the economy late last year anyway, had shovel-ready projects to go once they returned from lockdown. But it is incredible how China has recovered post-lockdown. The rest of the world sort of highlights that this is
it's a command economy. Can the rest of the world hope to
clearly
follow
the rest of the world's taking longer? Just amazing what China has done, and China's so dominant in terms of commodities demand as a starting point that it's integral in terms of how we've seen the rebound in commodities more broadly.
Well, the world has changed and the world is changing. There are new economic paradigms, big data, autonomous driving, AI, everything else and there's usually a resources sector or a resources issue involved in all those somewhere. How do you see all that playing out?
Yes, there's a lot of trends that we're seeing at the moment, themes that we're seeing at the moment, which are supportive for what we consider new commodities. So if you think of the electrification trend, I beg your pardon, so anything electric is positive for copper demand. You need some sort of conductor, obviously, for power. If you look at battery storage, electric vehicles, positive for lithium, to some extent nickel as well, and cobalt. But also, if you're looking at renewables as well. So renewables, if you look at rare earths, there's strong demand from renewables. Solar panels use a lot of silver. So all these trends are kind of playing out now, developing new markets and bigger markets in resources and new commodities. Some of the other things you mentioned as well, so you mentioned autonomous driving. So there's been autonomous haul trucks in mining for some time, all designed to bring down the cost and efficiency of mining. Safety is also increasing, so the safety factor of mining operations is getting better now with technology as well. So there's a lot of these trends that are not only driving new commodity markets, but driving down cost and increasing safety in the mining side as well.
The post-COVID-19 recovery is going to be driven by stimulus. And what will the impacts of stimulus be for the sector that you're involved in? Resources.
Yeah, look, I touched on.
And how variable will it be?
Yeah, sure. So I touched on some of the benefits that we're already seeing come through in terms of stimulus more broadly, if it's fiscal or monetary stimulus. The level of stimulus that we're seeing in the economy globally is unprecedented. Just incredible amount of stimulus, and it's positive for commodities demand more broadly. And really, for us, it sort of supports our view that we're entering a multi-year bull cycle for resources more broadly.
That's a big call.
Yeah, look, and we're comfortable with it, right? That demand, one is accelerating around this stimulus, and then the supply side, there's just been a lack of investment more broadly. So we just think we're at the early stages of that bull cycle. And to your point around stimulus, as a start, like I highlighted with China. China, really, has accelerated, activity, with stimulus, the driving force there. They've fallen back on some of the more traditional, sort of areas that they stimulate their economy. Infrastructure, as a core, which is steel intensive, or it feeds into power generation, and that's really fed into a strong demand backdrop for iron ore, and it's fed into a strong demand backdrop for copper as well. And then secondly, the rest of the world, to the earlier discussion, it is taking longer for it to come out of this COVID lockdowns that we've seen globally. That economic growth is coming through, but it's taking longer than what we're seeing in China, obviously, but it's coming. And when you throw a whole heap of stimulus at it as well, we see the backdrop for the demand environment being extremely supportive for the resources space.
You mentioned you can short and long positions. Talking about the short and long term outlook and future, how do you manage that, both preparing for the short term and preparing for the longer or medium term? What sort of structures and policies do you put in play, or is it really a constantly moving feast?
So it's really constantly moving. So as a starting point, so we do run a both top-down and bottom-up approach to our investment philosophy. So first,
one more dominant than the other, or not?
So we start with the macro, so start with top-down. So effectively within our fund and within Ausbil generally, we identify the commodities that we most prefer or least prefer, and that's the driver for our portfolio structure within Global Resources. So once we identify commodities we would like to own or would prefer to be short, for instance, we then start with the bottom up. So that's identifying companies that we would like to own or possibly hedge out using a short. So if we think about gold, for instance, we might be very positive on the gold thematic. We might own a number of gold producers which have production growth or cost out or earnings drivers coming through, but we might actually be short some of the distressed balance sheet companies or companies which have possible declining production or costs increasing to try and manage that exposure. So we start with the top down, so driving the commodity view, and then then move down to bottom up, so identifying which companies we'd like to own and which companies we'd like to short to adjust our approach. Luke did mention we do run a lot of protection on our portfolio at the moment. We are in a volatile world. The first quarter of this year was very volatile. There's a chance that could return, So we do make sure that we run protection within our portfolio at the moment through put options and managing our net exposure to the market, which is effectively our beta of our fund. So making sure we're not too aggressive in the current volatile situation, but effectively it's initially top down, then bottom up, identifying stocks that we like.
Let's turn our gaze to oil for a minute. A less loved commodity over recent times. What do you see happening with the oil sector 1, 3, 5 years out?
Sure. Less loved or most unloved sector in the market at the moment, right? It's
I was being polite.
No. So, look, we like it. And sometimes you've got to take those counter consensus calls.
Stop the presses. That's interesting.
Yeah, so we like it. And look, for a range of factors, we like it. We start with the near term, I guess, right? This is the most leveraged recovery trade that you can have in commodities almost, right? That the oil market is dominated by transport, and therefore, as we see, the world return from an economic standpoint, feeds into recovery and demand for oil more broadly. And look, this is at the same time that on the supply side, you've got OPEC that are managing the market as well, removing a whole heap of supply from the market at the same time that you're seeing forced curtailments from areas such as US shale as well. So, look,
you see the US still self-sufficient in oil?
Well, it's an interesting angle to come at it. I guess the real focus for the US has just been, how the US shale has been, sort of the swing producer in the oil markets over recent years. And what we're seeing at the moment is it's getting starved of capital, and we think that'll continue as well. So,
which would be an upward pressure on prices.
Definitely. And look, there's the only investment that we've seen go towards the oil market, or not the only, but the core investment towards the oil market more recently has been directed towards shale, which doesn't work at these prices. These companies are not getting access to capital, whether or not it's equity or debt markets anymore, and therefore, the reinvestment that was going in, is drying up as well. And that really feeds into why we like oil on a longer term basis as well, right? Is that, sure, I've outlined a scenario where we can see, this recovery trade and, rebalancing of the market, really tighten the market, in the next 6 to 12 months. But, a real feature of broader commodities more broadly, but oil in particular, is that there's been a lack of investment in oil and new supply in oil projects since the first downturn that we had in late 2014, and really that for us sort of highlights that while this commodity is out of favour at the moment, is that there's no reason why we couldn't see a situation where oil spikes back on the other side. That
where could it go? What's your positioning on terms of theoretical prices?
I'll probably get laughed at, but I can see a scenario where oil goes to $100 again. There is no investment getting directed towards oil. You've got companies like BP that are shifting focus towards renewables, taking a view that demand has disappeared. We disagree with that, but clearly just the access to capital, the reinvestment towards new supply, it's just not happening anymore. Recovery in demand, and there's a shortfall on that supply side. There's no reason why we couldn't see a spike in oil again. And that's the same for a lot of commodities, but oil is the most obvious at the moment for us.
Where do your views sit within your peer group? Are you?
I don't know if anyone else is going to call oil to $100, so maybe I shouldn't have said that. But at the same time, look, it's reflected in the fact that there is no positioning towards energy at the moment more broadly in the market. The market is underweight energy. And that's to my point that this recovery trade, it's violent, right? Is that you have a recovery in the commodity and you have people chasing it, from a positioning standpoint. So earnings are driving, the share prices as a starting point. And then as people, start to target these companies as well, is you'll see a big move back in oil equities.
I guess you're talking also about taking a bet on the speed of recovery. What's your view there? You think next year things will?
Yeah, look.
You're optimistic.
Yeah, we're optimistic. We're of the view that there's a vaccine that will come through the first half of next year, and clearly that'll be a big driver for the whole space. But most obviously, oil is the one area that is a key recovery trade discussion.
Does it make much difference to your calculations who wins the presidential election?
In terms of the oil market, not really.
But generally, the resources sector generally.
Oh, look, you probably highlight that China's the dominant, sort of political force in commodities at the moment. I don't know if you
we see.
disagree.
I think the two parties at the moment have similar approach to global relations, and certainly both want to stimulate the US economy as well. To struggle to see too much impact from a change in presidency, personally.
That discussion around trade wars more broadly, I think it comes from both parties as well. So whether or not we see increased volatility playing out, we certainly wouldn't rule out. But I think either party, the tensions there, seem to be at the forefront.
Indeed. Now you're a big holder in Lynas. Yep. Can you explain your history and current thinking about Lynas?
Yeah, sure.
Which is a company that gets a lot of attention.
Yeah, sure. And just preface, we can't make recommendations or give advice. Ausbil is a substantial shareholder in Lynas. It's public information.
I'm looking for thinking, not recommendations.
Yep, no problems. And obviously it's a large position within our fund as well. So the starting point is rare earths is a very interesting market. So one I followed for some time. Although there are a few rare earths deposits around the world, Lynas is the only company that actually separates final product outside of China. So within China, rare earths are mined, processed and separated. Around the world, there's deposits that are mined, concentrated and sent to China for separation. But Lynas is the only company that actually produces an end product in terms of rare earths. Now, we saw as trade conflict started to increase between the US and China in particular, there was some concern around China actually turning off rare earths exports to the rest of the world. Now that impacts things like high strength magnets, so NdPr, which goes into high strength magnets. Now that might sound a little out there, but the high strength magnets goes into a lot of automotive applications. So if you have electric seats in your car, if you have electric mirrors, windscreen wipers, etc., chances are there's a high strength magnet in your car, all the way through to speakers, to vacuum cleaners, to you name it. The applications are quite broad. So by China threatening to switch off exports to the rest of the world, there's a potential impact on supply chains. Also, some of the more exotic rare earths are used in military applications. So we come back to Lynas is a current separator of rare earths. It's very difficult to actually separate end product. It took Lynas many years. There's been cases around the world of failed attempts to separate. So from our perspective, Lynas is an
they have nailed it.
They've nailed it and performing incredibly well. So to us, it's an incredibly strategic resource as a starting point, but the IP within the company in terms of separation also is incredibly valuable as well.
What about the Malays? Is that sorted?
So we see it as broadly resolved. Politics in Malaysia has caused some road bumps to Lynas over the last 18 months or so, but broadly that's been resolved. So license has been extended, which is a positive. Disposal of their waste has been resolved, which again is a positive. There is a relocation of part of their plant that needs to be done in the next few years, which is a relocation of what's called the cracking and leaching circuit to Kalgoorlie, which is underway. So that's broadly resolved.
Any hiccups you predict there, or is that looking like going smoothly?
So I think it's going to go smoothly. Again, if we look at the IP within rare earth separation, it's all Lynas. So where we see some risk to new entrants to the market trying to start or design new plants, this IP exists within Lynas. So we think the design, we think the construction will be fine under the Lynas management.
Well, let's look at gold, another favourite commodity. Give me a little thesis, your current gold thesis.
Yeah, look, gold's been an exceptional performer this year, and look, it's up 30-odd% this year. It's been a real standout in terms of.
Has it peaked, or has it got more to go?
We think it's got more to go. It's probably worth just sort of touching on the key drivers that have supported it as a starting point, but we don't see those drivers going away. And look, there's really been three main drivers for us that have driven the commodity, and as a start, real rates. Negative real rates. There's a high correlation for gold to real rates as a starting point. It's probably the key driver to the commodity as a starting point. Secondly, in terms of the weak US dollar, that's also supportive. And then, thirdly, in terms of uncertainty about the outlook for the real economy as well. For me or for us, they're the three key drivers that have really supported the commodity. And And as a result, you've seen record inflows into ETFs over the course of this year. The gold space more broadly, from an asset perspective is quite small, relative to equities and other asset classes more broadly. So, while all of a sudden you've got these non-traditional players, the pension funds or otherwise that are starting to allocate capital towards gold, it's very supportive for the commodity and almost becomes self-fulfilling to some degree, right? So, what does the outlook look like? For us, this outlook just continues. It's hard to see an environment where real rates at any time in the near term start to increase. You've got the Fed last night highlighting that they won't be raising rates for the next 3 years. On top of that, the Fed have also said that they'll let inflation go as well, right? That while they won't raise rates, they're going to let inflation run, and gold's a inflation hedge. So there's a whole range of factors for us that are supportive for gold more broadly, and we see gold equities in sort of bull cycles as the way to play the space more broadly. That the ETFs outperform the commodity significantly through bull cycles, and so we expect that to continue.
That's the equity ETFs.
Equity ETFs, that's correct. That's a basket of the stocks as a starting point. So active managers like ourselves should be able to outperform even further.
Well, it seems to me that gold, oil, rare earths and resources associated with the new economy are all in your bucket list, and you're managing. I'm not quite sure where iron ore fits in the future for the fund.
Yeah, sure. As we outlined in the early discussion, we saw a real opportunity in iron ore over the last 18 months. It's been core position for the fund through that period. We did a lot of work. One in terms of exposure to Brazil, meetings in China, and really did a lot of groundwork around iron ore more broadly, and it's a space that's generated a lot of returns for the fund, and look, iron ore at 120, 130, it's what wasn't expected by majority of the participants in the market, and like I said,
But it didn't surprise you.
Oh, look, we just did a lot of work. I think what it highlights is that to some degree, the market's inefficient at the moment. A team like ourselves, that 40 years combined experience between us. When we target in on a commodity, we can do a lot of work that potentially isn't being done. There's less of that done on the sell side at the moment, and we really saw an opportunity, targeted in, and it's generated a lot of returns.
We were very comfortable. Iron ore was very tight for a prolonged period.
So from here we've reduced the positioning towards iron ore. You've outlined some of the areas, and we'll talk to some of the areas that we're repositioning towards. But I guess it's worth just reinforcing the point that we made earlier, is that we see a real opportunity in resources at the moment. We think we're entering a multi-year bull cycle. It's driven by stimulus, clearly driving an acceleration around demand, but it's also driven by supply, and there's just been a lack of investment in new supply for projects more broadly across the board, supportive for a lot of these commodities. We see a real opportunity for a fund like ours, to target in at both some of these next generation commodities, but also a range of the other commodities such as oil and gas as well, that are being starved of capital as well, and a real opportunity to generate alpha for investors.
Even in COVID and post-COVID times, obviously.
Yeah, well, I think the returns speak for themselves.
Yes, we've been long through most of this period and generated positive returns. So yes.
Guys, thanks for talking to us today.
Thanks
a lot.